All right, this is the final exam review for Accounting 6302. These are problem types that you're likely to find on the final exam. They won't be the exact problems, but they will be in the range of what you're likely to see. Okay, on the first one, they're asking us to, and I have sent all of these problems to you so you can follow along, you can practice on your own. On this first one, they're asking us to do a full costing and a variable costing for both 2021 and 2022 and explain what the differences are between those two. So we'll start with 2021, full costing and variable. Okay, so the sales are always sales. So we're told they're sold for $60 a unit, and we sold 1,900 of them in 2021, and so we get sales of 114,000, both fixed and variable. Sales are sales. Okay, then we have to do the cost of goods sold. So we've got the variable factory overhead of $20, so that's each. And then we have the fixed factory overhead. We made 2,000 units, but we only sold 1,900. The fixed factory overhead is 25,000. So we take the 25,000, divide it by the 2,000 units, and we get $12.50. Add the $20 variable cost to that. So each unit costs us $32.50. We sold 1,900 of them, and so we have 61,750, giving us gross profit of $52,250 on that. Then we take out the variable selling and administrative. That's $2 a piece times 1,900 would be 3,800. And then we have the fixed selling and administrative expenses. We're told that's $10,000. So 13,800 from 52,250 leaves us with operating income of 38,450. Okay. On the variable, so we're going to have the variable cost. You can add these together. The 2 and the 20 is 22. So 22 times 1,900 would be 41,800. That gives you the contribution margin. Gives you 72,200 minus the fixed manufacturing overhead of 25,000 and the fixed manufacturing overhead, fixed selling and administrative of 10,000. So a total of 35,000 leaves you with 37,200. All right. So, what's the difference here between the 38,450 and the 37,200? Is 1,250. We had 100 units that went into inventory, and it's that fixed manufacturing overhead of $12.50 a unit gives you 1,250 Okay. All right. And for 2022, we have the same numbers up here as far as overhead costs, all that kind of stuff. But this time we sold 2,100 of these. And so we had sales of 126,000. Again, the sales are the sales. Then we have the cost of goods sold, going to be the same 3,250. Yeah, 3,250 times 2,100, and that will be 68,250, giving us gross profit of 57,750, and that makes sense. We're a little bit higher than we were before, minus our variable selling and administrative costs. That's $2 a piece times 2,100 is 4,200. And minus the fixed selling and administrative costs of 10,000. Gives us 43,550 as our operating income. The variable costs, again, we have $22 times 2,100 is 46,200, giving us contribution margin of 79,800. Now we have the fixed manufacturing overhead of 25,000 and the fixed selling and administrative of 10,000. Gives you a total 35,000 in fixed costs and gives you 44,800. And I think I mentioned before that whenever you have inventory going up, and since we made 1,900 or made 2,000 and sold 1,900, inventory went up here in 21. We made 2,000 and sold 2,100, so inventory went down. So when inventory goes up, full costing will have higher income, and when inventory goes down, the variable costing will have higher income. All right, so that's problem number one. Problem number two is kind of an essay. I'm just going to verbally go over this and I'll write it down. Chad Fisher was recently appointed Vice President of Operations for Carey Corporation. He has manufacturing background and previously served as Operation Manager for Carey's Building Products Division. The business units of Carey Corporation includes divisions that manufacture building products, process food, and provide financial services. In recent conversation with Drew Williams, Carey's Chief Financial Officer, Chad, suggests evaluating unit managers on the basis of business unit data in Carey's annual financial report. This report presents revenues, earnings, identifiable assets, and depreciation for each business unit over a 5-year period. He believes that evaluating business unit managers by criteria similar to that used to evaluate companies' top management is appropriate. Drew has reservations about using the information from the annual financial report for this purpose and suggested Chad consider other criteria in the evaluation. So number one says explain why business unit information prepared in public reporting purposes might not be appropriate for evaluation of unit managers. One of the things you may not be aware of is that anytime a business has identifiable segments that produce either 10% of the revenues or 10% of the earnings for the company as a whole, those segments have to be reported in the notes to the financial statement. And so why they might not be appropriate is that by rule, by GAAP, those segments are going to have to absorb some of the home office costs. And so that may be something that those managers have absolutely no control over whatsoever. So that's not a good reason to do it. They also can be fairly arbitrary in nature as to why why they get reported the way they do. It could be based on revenues. It could be based on expenses. It could be evenly allocated. It could be based on number of employees. It just may not have any relevance to the actual use that is encountered by that business unit. Another thing is under GAAP, those business units can be either geographic or they can be identifiable business units. And so they may not coincide exactly with what the managers oversee. That could be a problem with certain things. When you look at just the bottom line of a unit, you may be in you may have given a manager a turnaround situation and they're just starting, they're doing a great job, but they haven't been able to turn around. Or, if when you get into your strategy, you're going to have one of the ways of doing it is called the Boston Consulting Group. You divide companies into low growth and high growth on one axis, and then low market share and high market share on the other axis. So you develop a 4-quadrant matrix. So one quadrant is going to be your stars. Those are high growth, high market share. High growth, low market share is going to be a question mark. You study that. Low growth, low market share is a dog. The mnemonic is you shoot the dog. And then low growth but high market share is usually your cash cow, and you milk those cows. So you may have a manager that's in the certain life cycle of that, and so it may or may not be a good investment. And so just looking at the bottom line numbers may not be appropriate. And then number 2 says describe the motivational impact if the proposal is used for the evaluation. Well, if one of those things that happens is that I described happens, then it's going to create some consternation among your managers that they're not being evaluated based on the work that they do. And then what might be financial information that would be more appropriate. Now this is why why we promote the balanced scorecard. You can have financial information such as earnings or revenue growth, market share growth, that sort of thing can be very important. Those are all good. So we may want to take that all into account Um, when we look at the product life cycle of the various things, trying to think right now, like desktop computers, or we still sell them to places like universities and that sort of thing. But by and large, we've largely gone to laptop computers. So if you're in the desktop division, that that is a declining market over time, and so but it's going to be around for a while still. And so you wouldn't expect revenue growth. That you're looking at how well are they going to be able to cut costs, contain costs, that sort of thing. So those are all good things to look at. All right, number 3. Fitzpatrick Incorporated planned and manufactured 500,000 units of a single product in 2022, its first year of operations. So one of the things it's telling you, since it's the first year of operations, is there was no beginning inventory, right? Variable manufacturing costs were $40 per unit of production. Planned fixed manufacturing costs were $1,200,000. Marketing and administrative costs, all fixed, were $500,000. Fitzpatrick sold 450,000 units of product at $50 a piece. Okay, so this is one of those full and variable costing elements. So under full costing, we had 50,000 units times $40 is $2 million. And then we had the fixed manufacturing costs of 1,200,000, gives us a total of 3,200,000. Divide that by 500,000 units. Oh, I said 50,000, so that would be 20 million, wouldn't it? Okay, so 50. That'd be 20 million, so that's 21,200,000. Yeah. All right. So 21,200,000, divide that by 500,000 units. Gives us $42.40 product cost per unit under full costing. So we're going to have sales of 450,000 units. At $50 per unit will be 22,500,000. Then we have cost of goods sold is $42.40 times 450,000 will be 19 million. That gives us gross profit of 3,420,000 versus our selling and administrative, the market all fixed, were 500,000. Gives us 2,000,000 $920,000 operating income. Okay. Under variable costing, sales or sales, we have $22,500,000. Our variable manufacturing costs were $40 a unit times 450,000 is $18 million. So that would be 4,500,000 contribution margin minus our fixed manufacturing costs, 1,200,000, and the fixed selling and administrative costs of 500,000. So 1,700,000. Will be 2,800,000. And as we've said, if inventory goes up, since we manufactured 500,000 units, but we only sold 450,000 units, then the inventory went up. So our full costing income is greater than our variable costing income. All right. Okay, consider the following three divisions, X, Y, and Z. And it asks us to calculate the return on investment, return on sales, and the asset turnover for each division. Okay, so for X, so we've got ROI, ROS, and asset turnover. So for X, the return on investment will be 330,000 divided by 750,000. Will be 44%. For Y, that's going to be 143,000 divided by 572,000. And that's going to be 25%. And finally, for Z, we have 580,000 divided by 2,900,000. And that's going to be 20% on Z. All right, return on sales. Okay, so we got our operating income of 330,000 divided by our sales, 2,200,000. Is going to be 15%. Here we've got 143 divided by 1,100,000. Will be 13%. And for Z, we've got the 580,000 divided by 5,800,000, and we know that's 10%. Right. Okay. Then the asset turnover is just the sales to divided by the 750,000. Is 2.93, and if you remember your DuPont identity, this times this will equal that, 44%, and it does. Right? So the asset turnover here for Y is going to be my sales, 1,100,000 divided by the 572,000. And that'll be 1.92. And then finally, we've got 2,900,000 divided by 580,000. No, 2,900,000 divided by the 5,800,000 income divided by the 2,900,000, and that's going to be 2. Okay. All right. So yeah, kind of that one's a little bit messy, but asset turnover is just simply the sales divided by the assets, average assets on that. Okay. Number 5. We've got Max Limited, produces kitchen tools and operates several divisions as investment centers. Division M produces a product that it sells to other companies for $16 a unit. It is currently operating at full capacity, 45,000 units per year. Variable manufacturing cost is $9 per unit, and variable marketing cost is $3 a unit. The company wishes to create a new division, Division N, to produce an innovative new tool that requires the use of Division B's product or one very similar. Division N will produce 30,000 units per year. Currently, Division N can purchase a product equivalent to Division M's for $15 per unit. However, Max Limited is considered transferring the next necessary product from Division N. Assume the transfer price is $12 per unit. How would the price affect the purchasing costs of Division N? Well, what it would do would make the you would end up subsidizing the new division, because at $12 per unit, that is less than they can buy it on the market, right? And it's actually less than the profit plus the cost, because if we take out the variable marketing cost for the internal transfer, 3 from the 16, that would be $13 that they would get. So you're actually subsidizing the purchasing cost and lowering that. How would the price affect profits of Vision? Well, it would destroy it would lower the profits by $30,000 for, so let's take a look at 1A numerically. If they bought it on the open market, it would be $15 per unit times 30,000. And so that would be 450,000 in costs, or if they transferred it at 12 times 30,000, that would be 360,000. So basically $90,000 subsidy by doing it that way. How would this price affect the profits of Division M? So 2B, they would sell for 12 times 30,000 equals 360, but they would be able to sell those on the outside for a net of 13. That's the 16 minus the 3 variable marketing costs is 390,000. So it would lower their profits by $30,000, $1 a unit transferred. How would this price affect Max Limited as a whole? Now, this is the interesting point about this, that as long as we constrain it to just the purchasing prices and not getting any behaviors involved, and assuming that the transfer at $12 or $13 or $12 doesn't affect the sales price for this new product. That's a pretty big assumption. Then it has no effect on the unit as a whole. What you've done is you're just transferring some profits from the old division to the new division, Division N. Division M to Division N is all that's affected. So it would have no effect on the whole. What if the price were $13 a unit? If it were $13 a unit, that's 1B. 2A would be 15 times 30,000 is 450,000 versus 13 times 30,000 would be 360. 390,000. So the price would save $60,000 to Division N. To B, this would have no effect, right? Because you'd sell it for 13, you'd sell it for 16 minus the 3 variable marketing, or the 13 without the variable marketing. So it would have no effect on Division M. So they should be fine with that. Again, that just strictly based on financial numbers, and then as a whole, it should have no effect. Okay, number 6, another transfer pricing problem. Assume 2 divisions of a company, P producing and B buying, are treated as investment centers for performance evaluation purposes. As the management accountant, you've been asked to provide input to the determination of the appropriate transfer price for an exchange of product between these 2 divisions. In case 1, Division P is experiencing a capacity constraint, while in case 2, it is assumed that Division P has excess capacity. The incremental production cost incurred by Division P to the point of transfer is $80 per unit. Division P can sell its output externally for $120 per unit, less sales commission charge of $5 per unit. Currently, Division B is purchasing the product from an external supplier at $120 per unit plus $3 transportation charge. Assume that Division P has limited capacity, thus for each unit it sells internally, it loses that opportunity to sell it externally. Use the general transfer pricing rule to determine the minimum transfer price for internal transfers of units. Okay, so for number 1, on that, you're going to have the $120 minus the $5, so it should transfer at 115. It would be fine to transfer at 115. And so that would work out fine. What is the maximum price Division B will be willing to pay per unit on any internal transfers? Okay, so 2, the maximum price would be 123, what it's paying right now. If anything more than 123, they would be losing money. If top management of the company allows managers of divisions P and B to negotiate, what is the likely range? So it will be 123 it'd be less than 123, greater than 115, somewhere between those two. And number 4, assume now that Division P has excess capacity. Use the general transfer pricing rule. Now, if it has excess capacity, now the minimum price is $80, because that's what it costs them to produce the extra on that. So as long as they can cover their costs, they might not be extremely happy about it, but they can't say we're losing money on this sort of thing. So, yeah. Given the situation in 4, would top management of the company want the transfer to take place internally? Absolutely, because that's $43 a unit that they're going to profit that they're going to get that they're otherwise transferring to an outside company on that. So, and it doesn't really matter anywhere between 80. So number 5, anywhere between 80 and 123, right? The company is better off. The closer you are to 80, the more the buying division makes. The closer you are to 123, the more the producing department makes. But as long as you're between these two, the company as a whole, when you look at both profits together, will be the same on that. Okay. Number 7. Okay, Axletronics is a manufacturer of components and accessories with total assets of $20 million. Selected financial ratios for Axletronics and the industry average for firms of similar size are printed below. and we have the current ratio, the quick ratio, the inventory turnover, and the return on equity, and we see those numbers there. Axletronics is being reviewed by several entities whose interests vary, and the company's financial ratios are a part of the data being considered. Each of the parties listed below must recommend an action based on its evaluation of Axletronics' financial position. And so for each, describe the analytical use of each of the four ratios above is number one. So the current ratio is how well you can cover your liabilities. Generally, it's considered between 1 and 2 is good. This one we see an industry average of 2.24, and this goes from 2020 to 2022. We see it's growing, and so they have better than average industry and better than industry average coverage of that. The quick ratio, on the other hand, is your inventory. Let's see, no, your cash plus your accounts receivable, and we see it's slightly below. Came up a little bit in 2022, but it's slightly below the industry average. So they're not quite in as good a shape as the industry on that one, but this is a total liquidity and how well they can absorb a short-term shock. Right. Inventory turnover, we seem a little bit low here. So this is the inventory turnover is your cost of goods sold divided by your average inventory. And since we know the industry average is 3.5, these people are well below that. And so either they're carrying a larger than normal inventory or they're not selling as much product. This could occur where their sales are the same as other companies, but they have more models, so they have to keep more inventory, that sort of thing. And then return on equity is better than and growing, and it's better than the industry average. So this is a valuation of how well you're deploying. You know, you would want to look at return on assets and return on equity. If your return on assets was about the industry average and your return on equity is better than, which it is here, then you're saying that the company is more levered than the industry average. So that these are just things that you look at. Then number two, for each of the four entities described above, identify one or two ratios from those ratios presented that would be most valuable as a basis for decision regarding Axletronics. So we've got Mid-Coastal Bank application for a 5-year note. So I would look at the return on equity because we're looking at 5 years and the current ratio. So they're able to pay back their loans. They're better than industry average, and so I would look at those two. In the Ozawa company, Ozawa is a new supplier and must decide on the appropriate credit terms. So I would look at the quick and the current ratios on that. That would be important if I was, selling to them on trade credit. Drucker and Denon, a brokerage firm specializing in the stock of electronics firms that are sold over the counter. Drucker and Denon must decide if it will include Axletronics in a new fund being established for Drucker and Denon clients. So we want to look at return on equity there, right? That's going to be the key metric for them. And then the Working Capital Management Committee. This is a committee of management chaired by the Chief Operating Officer. The committee is charged with the responsibility of periodically reviewing the company's working capital positions, comparing actual data against budgets, and recommending changes in strategy. I would look at the current ratio and the quick ratio. That's going to take into account your working capital on that. Okay. So, and we've discussed what's going on with the company. All right. Number 8, a leading author in finance, Alfred Rappaport, focuses his work on the importance of a firm's management, continually taking steps that increase shareholder value. In a recent article, he set out 10 ways to create shareholder value. A key topic in management accounting is the valuation of a company. Focusing on public companies, Rappaport explains how to increase business value to shareholders, summarize his 10 recommendations, and show how they can be related to costs. Okay, so all right. So number 1 says, do not manage earnings or provide earnings guidance. Do not focus on earnings as it reflects neither the company's value or the change in value over the reporting period. Make strategic decisions that maximize expected value, even at the expense of lower near-term earnings. This may mean divesting units that do not contribute to the company's long-term strategic goals, though they do contribute to current profits. Number 3, make acquisitions that maximize expected value, even at the expense of lower near-term earnings. Do not make acquisitions that improve only current earnings per share, but those that are expected to contribute to long-term value. Carry only assets that maximize value. Continually review assets and be prepared to sell units, brands, real estate, and other assets that can be sold for a price that is greater than their value to a company. Number 5, return cash to shareholders when there is no credible value creating opportunities to invest in the business through cash dividends and stock buybacks. Number 6, reward CEOs and other executives for delivering superior long-term returns. 7, reward operating unit managers for adding superior multi-year value. Number 8, reward middle managers and frontline employees for delivering superior performance on key value drivers that they influence directly. Number 9, require senior executives to bear risks of ownership just as shareholders do. And number 10, provide investors with value relevant information. Okay, so you can summarize these points basically as focus on the long term, don't focus on the short term, and so that's how are they related? Well, to cost management, well, you want to focus on the long term of a business so that you have sustainability. Sustainability is not just environmental or social sustainability, but it's also financial sustainability. And one of the current criticisms of the financial markets that we live in is that they have too much of a focus on short-term earnings, near-term earnings, that sort of thing. So, focus on long-term earnings values. And this is why companies do what we call create a moat around their earnings. So, like both Apple and Samsung have tons and tons of patents on various parts of the cell phone, and so they have to use each other. It prevents competitors from getting into the field without having to pay them a royalty. And there's other ways to create moats. You can do it through regulatory means. You can do it through just by superior delivery of product means. There's all sorts of ways to create these moats which is what you want to do, but to focus on the long term. Okay, number 9. Let's see, we already did that one, I believe. Yeah, we did that one. I guess it was duplicated here. So 10, we have Miller has the following information pertaining to the usage of direct labor in a recent period. Total direct labor hours used, the actual quantity. So we have the AQ times the actual price or actual rate. And so we've got 22,000 here for the AQ. The total units manufactured is 7,200. Over here, actual wage rate per hour was 15. So we can calculate that now. So that's 330,000. This middle one will be the AQ. We know that's 22,000. Standard cost data. The wage rate per hour is 14. So this is 308. And it takes 3 hours per unit times the 14 that they gave us above. So this is the standard quantity times the standard rate, right? This is the number of units. So this is the flexible budget. So this is 302, 400. All right. So determine the company's labor efficiency variance. Well, when the rate is the same, as we have on this one, that means that this is what makes the difference. And so we have 5,600 unfavorable because the one on the right is smaller, so it's unfavorable. Okay, the labor rate variance. So here's the rate, the standard rate. There's the actual rate. So we look at those two. And so that'll be 22,000. Also unfavorable because the one on the right is smaller. Okay, so summarize the journal entry to record the accrued labor cost and associated standard costs for the period. Okay, so you go with what you know. When we do standard costing, our journal entry to work in process, right, is based on the standard. So the work in process will be 300 into 400. Now we know we had wages payable of 330,000 because that's what we actually paid them, right? Okay, so now it becomes easy. You just have to balance these. But the other thing is unfavorable variances are always debits, favorable variances are always credit. So you have the labor rate variance is going to be 22,000. And then the labor efficiency variance is going to be 5,600. And so now we balance our debits and credits are equal. All right. This just looks like an extra one that I threw in here. Okay, Modesto Company produces and sells product Alpha B. To guard against stockouts, the company requires a 20% of next month's sales be on hand at the end of each month. Budgeted sales of Alpha B over the next 4 months are. In addition, the company expects to have 5,000 units of Alpha B on hand on May 31. Do a production budget for the months of June, July, and August. So we've got June, July, August, and we'll put the September out here. Our sales are expected to be 30,000, 40,000, 60,000, and 50,000. Then we need the desired ending inventory. The desired ending inventory is 20% of next month's sales. So that will be 8,000 of July, will be 12,000 of August, and 10,000 for September. So that's our desired ending inventory. Then we have the beginning inventory. So we just shift these down. This is 12,000 that we subtract off, because if it's in beginning inventory, we don't have to make it, right? And this is 8,000. But we were told this one will be 5,000, which is not 20%. All right, 6,000 would be 20%. But we were told 5,000, so we have to go with what we're told. And so this will be our production. So this will be 33,000 here. This will be 44,000 here, and this one will be 58,000. Okay, so that's a production budget on that one. Okay, number 11, this is a constrained resource. Kling Company produces and sells 3 products, X, Y, and Z. The following data relate to the 3 products. Labor is a fixed cost. So we have the various demand in units, the selling price in units, raw materials cost per unit, and labor time in minutes per unit. Okay, which is the most profitable product if there is no labor constraint? So the most profitable product will be the selling price minus the raw materials. So X is 160 minus 80 is 80. That's our contribution margin. Y is 190 minus 100 is 90. And Z is going to be 180 minus 110 is 70. So for number 1, the most profitable product, considering there is no labor constraint, is Y. And then which is the most profitable product if there is a labor constraint? Okay, so to do that, we get the contribution margin, which is what we calculated here, per unit of constraint. So 80 divided by 20 minutes is $4 per minute in contribution margin. 90 divided by 28 minutes is $3.21 per minute of contribution margin. And finally, 70 divided by 12 would be 5.83. So if labor is the constraint, this is our most profitable product. Next one, Olympia Manufacturing uses a predetermined overhead rate based on direct labor cost. At the beginning of the year, Olympia estimated total manufacturing overhead at $1,030,000 and total direct labor cost at $830,000. In June, Job 511 was completed. The details of 511 are shown below. What is the amount of manufacturing overhead costs allocated to Job 511? So the first thing that we do is we take the total estimated overhead divided by the estimated direct labor. So we get $1.24 per direct labor dollar. And then we want to know how much overhead was allocated to job 511. So we had $1.24. And the direct labor cost was $10,000. So we get 12,400 rounding, right? And so that's our direct labor cost there. Finally, Drenning Manufacturing produces flooring material. The monthly fixed costs are $10,000 per month. The unit sales price is $75, and variable cost per unit is $35. Drenning wishes to earn an operating income of $25,000 using the contribution margin ratio. Calculate the total sales revenue that is needed. So we take the 75, subtract the 35. That gives us 40. The contribution margin is $40 per unit. 40 divided by 75. $53.33% is our contribution margin ratio. Then we take our fixed costs of $10,000 plus the desired operating income of $25,000, and we divide that by 0.5333 or 53.33%. So 35,000, 0.5333 is 65,000. 65,629. Let's go ahead and prove that. Right. 65,629 divided by 75. Oops. Yeah. 65,629 divided by 75 is going to be 875 feet of this. So we know we sold, so our sales was 65,629. Our variable cost is $35. So $35 times 875 is 30,626, 627. I'll give this contribution margin of 35,002. Subtract off our fixed cost of 10,000. Gives us 25,002. So that just a rounding error. Okay, so that's all right. That is your exam review, and good luck.